Oracle is a mature software as a service company. According to them, over 3 billion devices run Java. While it's not my preferred language of choice when it comes to programming, we should not let biases like this affect our stock picking decisions. Especially because Oracle is heavily investing into AI infrastructure for the future. So let's try to evaluate whether or not buying the stock at today's price could make sense. Let's look at the numbers first. They made $75 billion in the last year in revenue, with 12.4 of that in net income, which gives them a profit margin of around 21% for last year. I think it's usually higher, around the 25% mark. They're currently priced at $160, which would give them a PE of 37. But keep in mind that this PE is based on last year's numbers. Their current trailing 12 months net income is a bit higher, so their PE is a bit lower currently. Now let's look at two different cases to see whether or not buying at today's price could make sense. We're going to look at a 5-year trajectory of a bear case first. It's a bit difficult to let a bear case here be not too low, but also not too high, because it's a bit difficult to predict how well their AI investments will plan out. Even if AI slows down in some space over the next 5 years, they still have a lot of orders and investments currently going in. So I think even in a bear case, even in an AI slowdown, they still get a decent amount of revenue growth in, at least something that is higher than their current mature software as a service revenue growth. And I would expect that the profit margin shrinks a bit due to these heavily investing into new infrastructure that isn't as profitable in the near future as one might want to be. And I think they have raised a bit of capital through additional shares and through debt in order to finance all of these AI workflows. And in the bear case, I could see that they maybe need to raise even more capital in order to offset some of the missing returns from this. So these assumptions would take the stock price to a future price of $121, which would be an annualized return of negative 5.37% if bought at today's price. But in contrast, let's look at a bull case. And instead, I gave them a revenue growth of 18%. That would more than double their revenue in the next 5 years. It's a bit difficult to see how much their revenue could really grow in the next 5 years. You know what? Let's give them the benefit of the doubt and increase it to 20% over the next 5 years. That would almost 2.5x their revenue, which is huge growth over 5 years. And I would assume that in a bull case, their profit margin gets a bit better, that things start to get profitable a bit faster than expected, and that their shares would stay around the same because they don't need to raise more capital. And I think a PE of 26 might be a bit low for such a big company growing at 26. So let's go up with 28. So I'm really cranking up the numbers here in their favor. And this would take the stock price to $334, which bought of today's price would be an annualized return of 15.85%. And if we average these two cases out, this would take the stock price to $227 with an annualized return of 7.31%. So there is some potential there in the company. There's a reason that it's selling like hotcakes currently. There's a lot of hype, and maybe my numbers are still a bit too low, but I don't just want to be driven by hype, because any chance that it could not work out as perfectly and as bloomy as these stories make it out to be, then the return instantly dwindles away, because you're paying a way too high price right now for a non-perfect story. And that's why I'm more on the cautious side. I do have the company on my watch list, but at a lower price. But that's just what I'm thinking about the company. If you guys have any thoughts about it, then let me know down in the comments, and I will see you in the next one. Bye.